Maybe you've been told that it's too risky to go all in tech stocks and you should have some safety in your portfolio. Maybe you should consider buying, some kind of bonds or have an allocation in utilities, because utilities provide a lot of safety and stability to the portfolio. This has been the case before 2022 and 2023, and you could see what happened to a lot of the utility companies like NEE, which is NextEra Energy. It pretty much wiped out all the gains. It's down 48% from its all-time high, sitting pretty close to the March 2020 lows. A lot of you asked me about this company. A lot of people loved it just a few months ago because it was a clean energy plan and all that kind of stuff. And it was just really loved by dividend investors, by investors that love to invest in clean energy and the future and all the hot things and all that kind of stuff. Well, now the sentiment could not be worse for NextEra Energy, which is a utility company, and they do a few other things. Most of you are familiar with the company. I have to admit, this is a very complex situation. The company is very complex to analyze. Utilities are not easy to analyze. I am not a utility specialist by any measures, but I did my best in this video to find the research and find everything so I can show you and tell you my personal opinion on NextEra Energy here in the video. So I really hope you enjoy it. Now, one of the reasons why it's been crashing so much, because one of the subsidiaries, which is NEP, NextEra Energy Partners, which is owned by NextEra Energy, they pretty much slashed the forecast of EPS expectation. It was 12 to 15% to 2026. Now it's only 5 to 8% because of higher interest rates and tighter monetary policy. It's pretty much killing them, and it kills the stock. The stock has been a disaster, very, very weak. Now sitting at $49 per share. But the company's multiple has been very inflated. I mean, for a utility company, yes, it's growing faster than other utility companies, or it used to, but it was trading at 36.5 times earnings at its peak. 36 times earnings for a utility company or clean energy or whatever. I mean, yes, they do get a lot of subsidies from the government, a lot of tax credits, but to me, that's an insane multiple for a utility company. But this is what happens when investors get excited about a new trend. They want to invest in the future. So this is why you had a lot of people buying NextEra at 35 times earnings. So I mean, this is an extremely expensive multiple for the kind of business model and the kind of environment that NextEra actually operates in. Now the valuation is looking much, much better. It's sitting at 15.5 times earnings, well below the March 2020 low, pretty much where it was trading at in 2012. This is a much more reasonable multiple for me just looking at this chart, but it's not enough for me to determine if NEE is a buy or not. Now, something pretty interesting with NEE is if I compare it to other utility companies, something like Duke Energy and SO, which is, I believe, Southern Company. Those two are not as exposed to clean energy as NextEra. NextEra is pretty much the best one, the largest one. It has a first mover advantage in clean energy, wind farms, and solar stuff. So there's no way pretty much, the business model is not the same. But it's just the same thing. It's a utility company. But if you look at the EPS growth for NEE, it has been growing much, much faster than Duke and much faster than Southern Company. So it normally deserves to trade at a much higher multiple than Duke and Southern Company, especially if you look at the structure of the Florida energy market. You look at their allowed return on equity are much, much higher. It's around 12%. It's higher than SO, and it's higher than Duke Energy. So NextEra has better margins. It's a better company in general. It's growing much faster than SO and Duke. But if you look at the multiple right now, they're pretty much all trading at the same exact multiple, despite NextEra being better than Duke and Southern Company. You look at SO, it's now trading at 16 times normalized EPS. You look at NEE, it's trading at 15.5 times. You look at Duke, it's trading at 14.8 times. You could see pretty much a few months ago, NextEra, it used to trade at a multiple, pretty much at a premium, close to the other competitors, but now they are all trading at the same exact multiple, which would tell me there's a lot of fear, more fear in NextEra than other utility companies. This is for good reasons, but I believe it's a little bit overdone. Now, one of the reasons for the fear within NextEra, and all utility companies have the same things, they do have a lot of debt. They carry a lot of debt to increase the high return on equity, because equity measures debt. So a lot of you might look at a lot of other companies. You're like, oh, it has high return on equity. Well, you have to look at the debt. Sometimes they just leverage up to show up the high return on equity. So sometimes this metric is not very accurate. But now they have $55 billion of debt. It's actually closer to $60 billion as of late 2023. But it used to be $50 billion, and from 41, 37, 26, this is massive, massive debt increases. One of the reasons for that for NextEra is because they have all those projects for the clean energy stuff. They require heavy CapEx up front. And a lot of time, NextEra is not going to experience the results until a few years from now once the projects are completed and they start generating profits and free cash flow. But they do require very heavy CapEx in the short term, but the benefits will not be seen pretty much in the short term. They will take a longer time frame to be seen, which is one of the reasons why NextEra as projects, they just require a lot of capex. But if you look at the cash flow profile of the company is still free cash flow negative. I mean, they have cash from operation, but I talked about the capex. I mean, now they pretty much have 8.3 billion in terms of cash from operation, but the capex is 19.3 billion, which is why they're carrying it a lot of debt. So they have around $10 billion in negative free cash flow before they even start paying the dividend and the distributions, which is very, very bad. But a lot of other companies, they operate the same model. I mean, like Duke Energy is also free cash flow negative. It's always been free cash flow negative. You have Southern Company, now it's free cash flow positive. So maybe free cash flow is not the best metric to look at in terms of, the utilities and stuff. But again, looking at this graph, it's nothing that makes me feel a lot of safety, or it's an ugly picture. But they do use something else. It's called, something like expected cash available for distribution. And they mainly just put up the maintenance capex. They're not using the actual capital expenditures that they use to build the wind farms and many others. They rely on a lot of debt, which is why the debt has been massively increasing. And now it's going to be harder to take on debt with the massive, interest expense they're going to experience, which is going to decrease the growth. This is why they decrease the growth target. Pretty much they cut it in half from 12 to 15% to only 5 to 8% annual. But other than the debt and the free cash flow profile, something else that worries me a lot is the debt maturities. If you look at the debt maturities of the company, they have 3.2 billion due in 2023, 5.5 in 2024, another 5.5 due in 2025, and then they have something like 500 million and 5.7 billion due in 2027. So they do have a lot of debt maturities in the short term. Now I know I'm gonna get arguments in the comments that this is a utility company, it has a moat, it's not going anywhere, it's not going bankrupt, it's gonna survive. I 100% agree. This is just the way it is. These companies are monopolies. They're not gonna go under or anything crazy, but they're gonna have to refinance some of the debt for the future or issue shares. I hope they don't issue shares where the company is trading at $49 per share, but they either have to issue shares or they're gonna have to refinance them as much higher interest rates, which could end up hurting the growth even more, even after, they revise it to 5 to 8%. So this is an ugly picture for me. It does not make me feel, safe at all. I'm just being honest. And if you look at the dividend yield of the company, now it's around a 3.5% dividend, one of its highest over the last 10 years. Again, you look at short-term treasuries, you get 5 or 5.5%, whatever it is right now. This is 3.5%, but NextEra does have 6 to 8% revenue growth. You have the treasuries that are not growing 6 to 8%. So there's a lot of moving parts, a lot of things going on. For me personally, looking at this entire picture, I agree that NextEra's debt, it is a problem, but the company is not going anywhere. Maybe the market has priced in a lot of that stuff because they cut the growth numbers in half. So it's much easier for them right now to beat on the growth numbers than it was a few months ago. So the sentiment is bad. A lot of the stuff got priced in my opinion. The multiple corrected to pretty reasonable range. It's now sitting around 15 times adjusted EPS, which is trading at its 2012 low. The dividend is only 3.5%. For me personally, looking at this entire picture, I see NextEra as a company that's somewhat undervalued. I would feel more safety if the dividend gets above 4%. They might end up cutting it if they couldn't refinance, although I don't believe this is going to happen. They're likely going to refinance the debt or issue some shares. These utility companies have pretty much access to unlimited financing, so I'm not worried about them not being able to refinance it, and they're just going to have to keep running the Ponzi scheme, just taking on debt, pay the dividend, do acquisitions or do the wind farms, and then just keep rolling it up. This is what these utilities companies do. This is what they've been doing for 20 or 30 years. This is nothing new for NextEra or the others, but I would feel better if the yield was above 4%. I think if it gets above 4%, NextEra would be extremely undervalued in my own eyes. It would be offering a little bit a higher return in the present than for me having to wait for some growth in the future and all these kind of stuff. So if it gets above 4%, in my personal opinion, it would be much more interesting. But I believe there's a lot of bad sentiment on the company. I would not be surprised if it goes lower. I'm just being honest. The sentiment is extremely bad. The yield is only 3.5%. Now investors, they don't care much about growth. They care about the yield, whatever they can get compared to treasuries, even though a lot of good companies like NextEra are being punished that have an amazing future. So it's not bad at such prices, but if the yield gets above 4% or 4.5%, which I would not be surprised if it happens, I think NextEra would be an amazing buying opportunity. For me personally, I'm not interested in owning utility companies or anything of that stuff, so I try to stay away. This is just my own opinion, but you do whatever is best for your portfolio. It was not financial advice, of course. Thank you so much for watching the video. I really hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.